It's really interesting being a civil and criminal tax defense attorney. You can always see an ebb and flow with what the government is going after. Lately, I'm getting a lot of phone calls about civil and criminal tax investigations involving the perceived illegal use of trust structures and private foundations that are being sold as legitimate tax planning mechanisms that when you really look at it and the government comes in after the fact and look at it, it's pretty easy to determine that income tax has been illegally evaded through these mechanisms. By way of example, Colorado dentist that's going to prison for $1.5 million of tax evasion involving an abusive trust shelter structure and a private foundation. According to a DOJ press release, Department of Justice, this dentist was just sentenced to 41 months in federal prison for tax evasion. Using a complex web of trusts and private foundations, he concealed over $5 million of taxable income, fraudulently reducing his tax liabilities. This case, a stark reminder that so-called trust-based tax shelters, often marketed as legitimate tax planning tools, can result in serious criminal tax consequences when they are used illegally to evade taxes. If you've utilized trusts, nonprofits, and private foundations in your tax planning, and if you're even slightly concerned whether those arrangements are legal or not legal, I can tell you this: you need to talk to me or someone like me before the government begins an audit or a criminal tax investigation, because either one can result in incarceration. The process is called voluntary disclosure. It's where you come forward and you admit you committed tax fraud in exchange for a pass on criminal prosecution. You're going to have to amend 6 years worth of returns. You're going to have to pay them the tax you should have paid in the first place, and pay at least a 75% fraud penalty on the year that generates the most income tax. If that's $100,000, you're going to get hit with an additional $75,000 as a financial spanking. Okay, so let's get back to this case. Court records reveal that Ryan Ulibarri operated Ulibarri Family Dentistry in Fort Collins, Colorado, starting in 2014. He purchased an illegal tax shelter for $50,000 that promised to shield his taxable income by routing it through multiple trust structures. The scheme involved the use of a business trust, a family trust, a charitable trust, and a private foundation. All four entities were created, controlled, and funded by Ulibarri himself. He did all this despite knowing that Colorado law prohibited trusts from owning a dental practice. He transferred the majority ownership of his dental practice into one of the trusts to further the illusion he was no longer in control of the income generated by that business. Although these funds were nominally held by these entities, Ulibarri maintained full control over the funds and used the money to pay his personal expenses. Needless to say, abusive trust arrangements are a high priority target for IRS criminal and civil tax enforcement. The IRS has long identified abusive trust arrangements as a major priority, particularly when the structures are intentionally designed to obscure or hide financial transactions and ownership. In this case, he deliberately structured these trusts to mask and hide his taxable income. These are precisely the type of factors that move a case from an audit where they discover it through a criminal tax prosecution because of the badges of fraud underlying the fact pattern. Think about this. The use of trusts or any type of a vehicle to hide income is incredibly risky, because the one thing the government does well is forensic accounting, is taking it to cash and following a paper trail. When to seek proactive legal advice when using trust in tax planning. Taxpayers who engage in trust-based planning, and believe me, I've seen a lot of people try and shift income illegally out of California by running it through out-of-state trusts. The government's not stupid. California isn't stupid. This trust-based planning, especially where it involves self-created trusts, nominee arrangements, foundations that people personally control, you should consider a careful legal review of these structures. Even when a trust has a plausible legal basis, the way it's actually used can easily raise viable and detectable red flags to the IRS, state of California, or any other state. When trusts are regularly used to pay personal expenses, or when the funds are moved in ways that obscure control or ownership. The IRS may just come in and treat the arrangement as a sham and pursue civil enforcement action. That's if you're lucky. For individuals who suspect their trust structure may not withstand scrutiny, I advise you to consult with someone like me or myself. I'm a duly licensed, simultaneously practicing criminal tax defense attorney, civil defense attorney, and a CPA. I have a master's in tax. The bottom line is, at some point, you're going to need to amend returns. And let me warn you, the temptation is just to amend returns and try and undo the structure. But an amended return can very easily be viewed as a criminal omission. It doesn't take a genius to say, here's the original return, here's the amended return. What changed and why? Okay, those are dangerous questions. Anything that focuses on your intent can put you in jail. Dissolving improper structures, initiating a disclosure process before an audit begins. Whatever you do, consult with a tax attorney before that happens.